Welcome, everyone. It's been a while since we've done it. Just make sure this old machine hasn't been cranked up for a while. Let me know that it sounds okay and all that. I'm going to put the CNBC feed because the announcement will be out in just a minute. So, yeah, just let me know everything's good on sound, okay?
On the other side of this.
So let me make sure I'm real live on this. We should have the announcement here any second, so bear with me while I'm setting up some stuff. How's everyone doing, by the way?
Investment research. So, ladies, that's exactly right. I don't.
Oh boy. Hang on one second. Bear with me, folks.
Surprises in terms of what we expect
I'm all
from the
thumbs right
policy
now.
rate. No change there. I think there's a.
So wait for Steve Leisman to come up, and then we'll go live here. So, yeah, we'll spend a couple hours together today. I've got a lot to talk about. Haven't talked to you folks for a while, and I hope you're enjoying the Substack. Last night was the last free version. You're going to have to sign up. It's $8 a month, folks. I put a fair amount of work in, and I'm trying to make it very robust. I'm actually writing an article on ETF hacking right now, which will be included in that. There's a whole bunch of stuff. So I've kind of switched around what we're doing. So I'll talk to you about that here just in a few minutes. So I just want to make sure we have this live when we come up here. So I'm just waiting for this to come live. I think, where are we here? Yeah, we should be any second. I think there's a little delay here.
Going back just a little, though, about debt.
So, yeah,
It's just about flat. This is pretty much the holding pattern. And Microsoft and Alphabet
pretty weak
aside,
day today ahead of this, which is
probably much more of that holding pattern as well.
kind of interesting.
So keep an eye on that.
So I'll keep that background noise out. Anyway, yeah, we'll get it. Here we go.
Federal Reserve leaving rates unchanged at 5.25% to 5.5%, but making big changes to the statement. The statement twice mentions the possibility of changing the funds rate, setting out the circumstances for those rate cuts that maybe are nebulous, but maybe even a bit hawkish, depends on where you come from. I want to read you the statement that says here, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. It later says inflation has eased, but that it remains elevated. So it's saying the committee will only cut rates when it's confident inflation is moving to the 2% target. No mention in the statement of whether it has that confidence. The statement also says, quote, in considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee removed that bias that was in there for hiking, where it talked about additional firming. That's no longer in the statement. The risks to achieving its dual mandate, the Fed says, quote, are moving into better balance. On the economy, there was an upgrade saying it's expanding at a solid pace. Had said it was slowing in the prior statement. Job gains, it says, has moderated but remains strong. And it removed a section on concerns about the impact of tightening credit conditions. That's gone from the statement. It also removed a section on accounting for prior tightening and monetary lags. It was a unanimous decision with new voters Barkin, Daly, and Bostic and Mester voting as well. So cuts, guys, are obviously in play, but the Fed at best is not telegraphing any timing around it or amount, and you can be ready to suggest those cuts may come later than the markets now expect. Tyler?
Okay, so pretty much as expected. I put the reaction to the market up there. We're trading right now at 49.01, and this is where in the past the buy the dippers have come in and stepped into this market. It's been weak all for the entire session today. It was actually in the Substack last night. I did mention that market turbulence was on the way. It's very obvious that we're getting a little frothy here, and especially coming into the final day of the month, coming into February. So make sure you get signed up for the Substack, because I'm going to go into some pretty in-depth stuff on the long-term outlook as we come into the beginning of the month. So we'll go ahead and talk about a few things. We'll watch the, looks like the market is trying to consolidate here at the moment, right around this 4,900 level. But let's get into a couple of things that I wanted to talk to you about, and I appreciate everybody coming. We got about 170. Be nice. I remember back in the pandemic days, we used to have 1,000 live. That was fun. We're going to get back, folks. I've been through a lot of personal issues that I've been dealing with, and things are kind of coming around. But my decision, before I get into some of the things I want to talk to you, my decision to take the daily commentary to the Substack was it takes me about the same amount of time. So I'm not looking at saving time. I'm trying to give you much better information and something you can put your hands on. In the beginning of the week, I have the entire economic schedule there, what the expectations are. It's really, I'm building it, and it's still coming together as I go through every week, but I'm building it as something you want to have on your desk all week on some of this stuff, and building some expectations. The market grid's in there, so you're getting a free market grid, those of you that have not bought the indicators. And but the everything I'm doing there on Substack is really, it's brought the hour-long, everything that's in there for the most part is what I was doing on the live streams every day. And so it's interesting because it's taking it from an hour down about 10, 12 minutes. And if I tried to do the 10 or 12 minutes on a YouTube video, it would not come across the same way, and certainly not have the depth of thought that I'm putting into this. So anyway, Kendall Report .substack, get signed up. Twitter's got a thing against Substack, so I'm not sure how many people are seeing the retweet when I launch it every night. So anyway, so let's get into some things that I think are really, really important, that were probably, just from the statement that they put out today, looks like they're moderating things. But I keep telling you, there's one thing that matters here, and the thing that matters is this QT. If they don't change QT, that tells you basically that there's still actually, while they're taking that selling off, what I'm looking for is when they stop selling, it's going to tell us what they think the risk is in the marketplace. I mentioned in last night's newsletter that there was around 7.7 trillion. I'm estimating somewhere between 6.5 trillion. So there's another 1.5 trillion of runoff to happen before we get to a level that I think they're probably going to announce that they're going to slow down or even stop the QT. And let me explain why I think that's really important. And to me, that's important because it now tells us what the balance sheet needs to look like on a relative risk basis. You know, we've seen the economy. If you go back, I see people talking about, going back and talking about 2008. It's 2024, folks. The economies have expanded crazy numbers, right? We're almost triple the size. Everything is tripled. So take whatever you thought it was big numbers back in those days, and you got to multiply by 3 or 5. And as you know, and I would just tell you, it's still for anything I've done up to today on Substack is free. So you can do a free account and you can go back and look. And the reason why I mention that, if you didn't see the 2024 outlook, I think that's worth taking a very good read of, because there's some things that I'm talking about and really looking out toward more getting beyond the election. Well, who knows what kind of craziness is going to happen around that event. But as we come into 25 and 26, man, what I'm seeing here is some crazy potential in the markets. It's interesting. I'll get into a few minutes of this. We've got 20 minutes or so, so I'll go in. I don't know if this will end up being a rant or not, but there's something that's going on. Everybody, in my opinion, is focused on the wrong numbers, meaning everybody's talking about the debt and what the debt's going to be in 2030, and that's all it's that focus on the debt. Like, let's focus on debt. And no one that I'm hearing, I have a few people, I should say, I don't like global labeling to no one, but what you're really not, folks aren't looking at is what the potential growth of the economy is. Now, I happen to think that this is the fourth industrial revolution that's coming at us, and that AI is going to change it will change how employment looks. I think there's going to be a lot of new jobs that will be created. Most folks are saying it's going to eliminate jobs and all kinds of people are going to be out of work. No, they're not. People will work. People want to work. There's productivity that's going to happen. And that's been my big argument, is that people will still are... we have a thing around here when we're doing process. We always ask the question, is there a man in the middle, or is everything quantitative? Is the computer doing the work? So in the case of our portfolio management and other elements, it's 100% being run by the computer. There's the only part of the man in the middle is the selection of the stocks that are going into the process. And that's the hardest part, actually, of everything. But what I'm talking about here is there's going to have to be interaction with humans to run a lot of this AI. And I think there's going to be an explosion in productivity, therefore an explosion in GDP. And it's very possible that 3 years from now, we're going to see something completely different than what everybody's talking about. Everybody's talking about we're not going to be able to pay our debt. I'm saying we could grow ourselves out of this situation if productivity gets to some of the levels that I think it's going to get to. So take a read of that, because I think that's something to look at from that standpoint. So, just looking at, I got logged out of here. So market, just looking at a quick market update here. We're seeing that it's starting to stabilize a little bit here. And I suspect once Powell starts to talk, it'll probably rally back. So there'll be some good things going on there. So, and I see somebody talking about coming back to listen, the Substack's way better. And I'm going to fill in the gaps with Substack by doing a video like I did on Sunday. There's going to be more content coming out on YouTube. It'll be more macro based instead of the micro day to day. And I think the micro day to day, I wrote that type of commentary for almost 20, 25 years every day for our institutional accounts. I've expanded what I'm doing every night. I'm actually really enjoying writing again. That's been good. And then, like I said, I've got a bunch of projects that you're going to be glad that I started writing again, because there's going to be procedure stuff put together for stock selection, portfolio construction, a lot of stuff. What you folks know me through looking at charts and talking about what's going to happen tomorrow. Where the big money is in portfolio management, managing your 401k, all those kind of things. And I'm just migrating everything over. I'm in the process of basically rebranding all of my social medias right now, because basically there's a new message that needs to be out to who I am if you're looking to follow me. And because I am going to shift a lot of things. So I still have that technical analysis. It's nice to write it down. You can go back and read it. Be really easy for for you folks to.
Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Yeah, of course that happened. Of course you can't hear me. So maybe that was good. Yeah, very frustrating when things get too disrupted like that. I apologize. It was not my doing. Anyway, yeah, so you all missed a great, really good rant. I was in flow when the internet went down, so that's pretty classic. Yeah, that was me. So let's try to get back into flow. The Fed is obviously still kind of going, we're not going to lower rates. That's been the dialogue. I went through, I'm not even sure how much you folks were able to hear of what I said earlier before the internet went down. But my whole premise is this QT, and Paul just mentioned the QT, that they've got it down by maybe $1.5 trillion in the better part of 2 years, year and a half plus. And that's an issue because to get it down to the numbers I was talking about when I started the previous broadcast was that we need to get back to $6.5 trillion is my estimate, where we need to get it. The pace that they've been going, that's going to take another year and a half. And that would be really bad. I think what probably happens, the Fed still got their tail between their legs as far as the whole inflation thing goes. They got caught with it was transitory, and we know all the story. It went from transitory, but no, it's not. Now it's sticky, and now there's you hear in the background talk here when he's talking, is he's saying that, hey, this stuff is the longer term expectations and market expectations and inflation are higher than what they would like them to be. So they're going to keep things higher for a while. And I've been talking about maybe it's appropriate just from that dialogue to talk a little bit about some of the things that are likely to happen as far as the yield curve goes. I've been talking about that for a while. I might be able to put you folks up on a screen for a few minutes, and maybe we can draw on a drawing board and talk about it. But I think all we really need to understand on the interest rate scene is that we're locked in around this 4% level on the back end of the curve, starting at, I would say, 5, 10s, 30, and that back end. On the front end of the curve, we're a little elevated in the 450 plus range, and then, of course, in the very front end, since the Fed's maintaining their current Fed funds rate, the effective rate is roughly 533 every day. I think that was the number this morning. So we're looking at really 530s. We come into the 13-week, get to a 1-year T-bill. They're going to stay above that 5% range, probably 5.15, 5.25. And then as we get into, we start, the threes are not really well watched, but the 5s, 10s, and 30s will start to just stay stable here. And I think those are the numbers that are important. Folks have been focused in on the inverted yield curve for a year and a half and sticking with their guns that there's going to be a recession because of those numbers. And I told you, not going to be a recession. I still don't see a recession. In fact, the scenario that I was talking about a bit ago is really productivity increasing, and that over the next 3 to 5 years, we actually grow our way out of this debt. I know that sounds, like I said, I don't know where the internet got cut off on the previous live cast that I was doing, but the bottom line is that productivity goes to where I think it's going to go, GDP is going to grow, and therefore everything's going to get much, much bigger from the standpoint of the overall base of the economy and what the Feds and the Treasury and everybody's going to have at their basic usage, including tax base, everything. So without breaking and getting down into the weeds on that stuff, we're really looking at the potential to grow out of this debt, and all of a sudden you're back at 40 or 60% of the GDP ratio to total debt. And I kind of laugh to myself. There's some guy that I follow on Twitter just because he does these rants, and I want to hate him, but I can't. And I'm trying to bring up my Twitter account so maybe I can see him. He's a conservative guy, but he's got kind of a voice, and he hem-haws and whines about all the debt and how it's almost like an extension of zero hedge. And I've been telling you, if you want to know what's not going to happen, go to zero hedge. Not that everything that they've had in there are bad, but for most part, all the doomsday stuff that is being projected is not, it's not going to happen. And that's what I've been telling you. I'm very, very optimistic going forward in our economy and what's likely to happen from productivity and GDP range. So I just don't see it. I think we're sitting here, folks, in the we'll call it the Henry Ford moment. We're going back to the second industrial revolution, where automobiles and automation of a lot of things, manufacturing, those things changed a lot of how the economy operated. And we've watched this, and this is one of my arguments when you're looking at the U.S. economy, looking at the world economy, and people are always trying to look in the rearview mirror. Well, back in 1930, well, it's not 1930, it's 2024, and the metrics are different. The banking system operates different. We can move money in nanoseconds now, where it used to take 2 to 3 days to settle any kind of transfer. There was a time where the banks could settle, I think, in 2 or 3, but they were making all of us, if we were transferring money, it was a 7-day settlement. So they would literally be making money off of that float. There's still a float, but that float has went away substantially. But what it does, it makes everything much more efficient. As markets get more efficient, as we get digitized, especially like going back to decimalization back in the markets back in the 90s when that happened. I used to be a floor trader, and one of the guys that ran the hedge fund that I worked for said to me, I went and visited him. I hadn't been on the floor for about 4 or 5 years. I was in San Francisco, and I went up to see some of my old friends, and the guy that ran this hedge fund, he goes, it's not like it was the old days. There's no juice left in the market. So every time we've seen these transitions from decimalization and then the settlement time getting shorter and shorter, ultimately should be same day settlement. There's no reason why it's not now. So the brokerage firms and all the clearinghouses are still playing a little bit of the float game, and they're still making tons of money on that because the money is so big relative to what it used to be. So there's still plenty of money. The efficiency is there, but the money is also still there, and that's what's driving all of this. So we have a lot of liquidity in the system here. Let me get Jay Powell out of the background here. So we have just a lot of liquidity in the system, and that has been the one thing that saved us from the, I'm going to do air quotes, the banking crisis last year that never happened. I see that I think KRE is getting hammered today for 3%. So there's a New York bank with some issues. So markets are quick to respond. It's probably not a systemic issue. I haven't had a chance to look at it. But my point of all this is you're going to have banks are in the risk business to a large degree, especially the commercial banks. Those folks, there's always going to keep this story about CRE, commercial real estate, and all of those things continue, and they'll be ongoing. But in the end, they'll all be handled, and there's plenty of money around to actually handle these situations. Let me get rid of this little dinging noise here. Okay, so yeah, it's an interesting world we live in. So I wish you folks could have heard that rant that I was on when the internet was down. I didn't realize it was down. But anyway, we've got about half of the viewers back. Man, that's disappointing. See what you folks are talking about. Yeah, the great. Even someone says if the debt doesn't grow at the same rate, it won't. By the way, not if you get to these productivity numbers. I have some numbers. I did some research on this, on the and even if debt were to grow at 10%, see, once you get the cash flow to a certain level, you don't need the debt anymore, and that hasn't happened. They're still spending money like drunken sailors. We know that. We're talking about 2025, 26. There's going to be a new administration around. Who knows who will be running what as we come into these latter years. But I think it's, I've referred to the some of these things that are out there right now. What's going on right now is kind of the roaring 20s. If you look at the reset that happened after we saw, after the pandemic, I mean, that the market got creamed. It has been straight up ever since 2020 for the most part. We had a down year in 22, but for the most part it was down. So let's see here. I'm kind of getting an urge to kind of go into something, and I'll come back to it. I'm just looking at what time we got. Let me go to another screen here. Let me come over here. Good. Now, I'm telling you, this old machine is not running like it used to. Yeah, that's why I'm trying to get to another screen, and my little screens are not changing. Usually I push a button, and let's see what this one is. Yeah, here. Yeah, so there's the roller coaster somebody was just talking about. I'll put it up here and just take a look at what's going on. We're back to 10.49.10. We printed up to 29, and then back to 10 here. I'm not sure we're going to be able to get out of the way here from the standpoint of what's going on. Yeah, folks, listen. I'm just looking at a couple of things here, and I see somebody brought up, World War III, and listen, that's a game changer. That's more or less, maybe it's a black swan type thing, but in real world, if you can see it, that everything that's going on, is it really going to be a black swan if something happens? Maybe if there was some attack. Only thing I would see is if there was an attack on mainland U.S., that would be pretty big. Every war we've been in, we've been isolated here in the U.S. from any of those things actually occurring, meaning that we've not had to fight a war, have to go back, way back into the 1800s to get into that stuff, and not civil wars. But I think that's probably more of a threat than World War III, to be honest with you. I live in Arizona here, and also have interest in state of Texas, and I can tell you, folks are pretty much fed up in both Texas and Arizona from the standpoint of what's going on. So I would worry more about that. Yeah, and I see somebody mentioned we're not watching Powell, but yeah, they're not going to lower rates. Like I said, only thing that matters is when they say we're not going to sell any securities anymore. That will matter, and when that happens, I'll break it down. I've talked a bit about that today. So the standpoint of what the impacts of that will be, I think, will be major. They're not going to lower rates. There's no reason to lower rates. I mean, why would you lower rates? Look at the JOLTS numbers came in stronger again. Employment numbers, everything. The employment situation's strong. There's nothing they can do to knock this down. And I think it's interesting that folks are still kind of hanging on. I mentioned this earlier, to the inverted yield curve and that whole scenario. There's going to be a recession because of the inverted yield curve, and I've argued for a long time, no, there's not. And now we're in the range where something should start, if that scenario were to play out, that the inverted yield curve would happen. I saw a really interesting thing. I think it was posted on Twitter, and it was the economist from SoFi. You want to talk about a good fade. They're talking about 5% unemployment, treasuries going up, and that's their scenario they're playing. So you can fade that trade pretty good. Like I said, 4.25 is about the top end that I see that we could get to. Yeah, just looking. This is a 1-minute graph that I've got that you folks are looking over my shoulder here, and we're. Yeah, it looks like, matter of fact, if we look at the algos, right now the algos are suggesting a possible little turn if we can hold above this 200 moving average here. Maybe we can get a little bit of a rally up, but it won't be much. It's going to be locked in a range probably right now of 49.10 to about maybe 15.16 at the moment. And so we'll continue to watch that. I'll just kind of interact with you. I'm just looking at some comments here. Yeah, Greg, I'd love to talk a little bit more about the military age folks that are pouring through the southern border. That's kind of scary. We could do a whole broadcast, but this is financial, so we're going to stick to that. I do have plenty I'd love to talk about, but we're not going to. But here's the thing: those folks that are coming across are, I guess, arguably also are working folks. If there's so-called infrastructure jobs and things of that sort, they can be trained. If you recall, going back to 2006 through to maybe up to the housing crisis, if I'm in Phoenix, Arizona area, I now live up in the mountains, but at that time I was down in the valley, and what was happening then was a lot of Hispanics, Hondurans, all kinds of people, South Americans, were working on these crews, framers, all that. When the markets collapsed, when the real estate markets collapsed, and all that building went away, then that workforce got distributed out, and now there's still a lot of building to go on. And I guess I was flashing back to this, and you folks have known me for a few years. But I was flashing back to some previous times and in life. I put some stuff out on Twitter, pictures of my newsletters. My very first newsletter I wrote was on August 26th of 1986. That was the first time I wrote a newsletter for what I had a company at my own broker-dealer called Kendall Financial Group. And it was a broker-dealer. It was also introducing broker. I had been one of the top producers at Prudential and started my own company. I get tired of people that didn't understand what I did telling me what to do. And that kind of started me into more of a research role, more of an analyst, and those type of things. I kind of became my own everything. And I've been a multitasker. I had a computer on my desk since 1980. And so for 40 years, I had an Apple II with VisiCalc. So I've been really into the technology. But as we look at where we are today and everything, you can talk about black swans. I've tended to be, for the most part, actually called the crash in '87 really, really well. Had the proof of it. Had a nice black turbo Porsche I bought right after the crash. That was one of my rewards for being right. But everything always has been painted out that when I look forward, America was still there. The world was still there. People still wanted to work. People desire, all of us that are on this stream right now are wanting to move on with our life. We have goals, we have families, we have other things that we want to do. And, I'm at the far end of the spectrum now. I'll be 72 this year, so I've already been through all of those phases of life that a lot of you are in the middle of or coming into. And that is so motivational from that standpoint, and as messed up as society is today, those desires are still prominent, I believe, with most people out there from the standpoint of wanting to do that. So that's why I've always been an optimist to a large degree. I'm a short-term pessimist and a long-term optimist, and it's always been that way for me. When I look out in the future, I'm going to do, like I said, make sure you get signed up for the Substack, Kendall Report.
Substack.com, $8 a month. On Sunday for Monday, I'm going to write up the longer-term viewpoints of what I see happening in the market. I'll probably have at least one, maybe two YouTube videos that will come out next week to kind of back up some of this stuff. But the realities are is when you look out, it's still optimistic. And and the World War IIIs, and all of that, they could happen. It's one of the things you learn after when you get old is you just deal with life as it comes at you. And sometimes it's good, sometimes it's bad. As I've said before, I've been lucky enough to have more good than bad, but certainly I've had all of the above. You don't go through life, none of us unscathed, as they say. So whether it's divorces, losses in family, all that stuff, it's life and human life. So, but I think that what I always see is I'm optimistic for humans. Okay, I wish I'm with Elon Musk. We need to make more of them, and we need to get a lot of things under control that seem to be out of control at the moment. But the forward-looking aspects of the potential for, and I think it goes beyond potential, folks, on AI. I'd said the other day, and this is something else I'm going to work on. I'm writing right now. I'm writing a letter on ETF hacking. It's going to be a multi-part document that I'm putting out that's going to go step by step how you can do it. We're going to put out a special on making sure that we get people that get committed to doing this, the folks that have 401ks and that. We're going to make it really easy for you to commit, at least to make a serious effort on doing these things with technology that I built. and then, what I'm trying to do with all of this, excuse me, what I'm trying to do with all of the efforts I'm doing is trying to move us all forward in a good, solid way. So optimistic, I'll stay. I think GDP goes through the roof. I think debt becomes a non-issue 3 years, 5 years from now. And think about it. It's like if you watch the news, I keep telling you folks, you want to be good at the markets, just be a contrarian to a large degree. Everybody is telling you about the debt. Therefore, it can't be the problem. There's something else that out there. It's like, do they not want you to participate in the boom? So here's where I was going to go. I'll go down this trail a little bit. Is that I think that the opportunities in AI are not just with NVIDIA and the obvious Microsoft, all those folks. I strongly believe that mid-cap and some of the small-cap companies are a nightmare, zombies walking around. It's literally, a zombie world in the small-cap world. But as you get into mid-cap and lower capitalization, large caps, whatever, that's even hard to define anymore. We got 2 companies over $3 trillion in valuation now. But when you get into that, those are going to be the companies. Those will be the companies that you're going to be able to benefit the most from, that they are going to figure out how to take AI into their businesses and get productivity to grow. And, so I always say you want to find the mid cap that can turn into the large cap, and better yet, a small cap that turns into a large cap. And you want basically the capitalization of that company to double and triple. That's where the money's going to be made, not in the companies where you're going to make 15%, 20%. You should be able to get, 3 baggers, maybe more out of some of these companies that are out there, because they are going to be the ones to benefit. That's where I'm talking about. So the reason why I'm kind of forcing myself with this ETF series that I'm writing on Substack that I'm getting, I finished most of part 1. I just need about 2 more hours. I'm going to get that out the door. And also I'm working on basically a pretty in-depth book on PPMs and some of the other stuff on our indicators. We're going to get all this stuff out. Like I said, I'm having fun writing again, spending my time doing that stuff than what I've been doing with it in the last couple of years. I'm just kind of coming into a new phase, if you will. But the bottom line is these companies, these mid-cap, these small-cap, those are the companies where you make the money from AI. Not that there's not money in the folks that act and look like NVIDIA. I was down in Phoenix yesterday, and I can tell you I drove by the new TSM plant, that Taiwan Silicon new factory. It's going to take them multiple years, and I laughed. I said to my wife, I said, it's amazing what people will do to get a computer chip, to get silicone. It's amazing what, they're building this massive thing. Doesn't matter where you're from, Taiwan. I mean, we've got great companies here, Intels and AMDs and folks, but, it's just like the reason why that's happening is because of the the need that's going to be to fulfill that silicon chip it's going to take to drive this thing I'm talking about. And if all you have to do is look around and see where the real productivity, where the focus is. Okay, so a little bit of a ramp. Yeah, and Harry's talking about, what do you think about quantum computing? All of this stuff, folks. This is where we're going. This is the 4th industrial revolution, and this one will. I put in my
annual report, I went through, and the best I could find, and go all the way through the previous 3 industrial revolutions and tried to see what the effects on GDP was, at least from a historic standpoint. And I think I did some pretty good investigation there, and none of those previous periods had growth periods, I think close to 3% when in the 60s, and when we started to come into basically the world we're in right now from the standpoint of the computers and the computing, and now we're going into a new phase, not only quantum computing, but the encryption and all of this stuff is just going through the roof right now. And I think that this is what I'm talking about. I'm not an expert on this stuff. I'm just a guy looking to invest and try to figure out how to benefit from it, and from what I've been doing for 40 years. And it appears fairly obvious to me that these things that I'm companies talking about, so I keep going in a loop here. Let me go back one second here, is what I'm really talking about. Like when I'm writing this letter on ETF hacking, I want you folks to be able to read this thing. Even if you don't use it's going to be a lot easier to use it with our technology, because we can monitor a lot of assets simultaneously, mix them into a portfolio. We built a virtual portfolio manager. That's WaveTech is VPM, which is a virtual portfolio manager. So you can handle a lot of assets and mix them and all that. We're working on automating the entire process, so it'll just go right to your broker dealer. But the point of that is I want this document to at least give you folks the ability, when you go into ETF hacking, for years, folks, we did the same thing with mutual funds. And I'm not talking about hacking indexes. Who cares about indexes? The managed ones. I mean, you got to find something a little better than ARC, even though it's bounced a little bit. There's some really good thematic views of the world that you can go in and chop it out. Last year, a year ago, right now, I was telling you folks about the home builders. You would have followed that, went in and there were 21 stocks that I chose out of there, and that got you 75% return last year on 21 stocks, just following the bouncing ball. And it's like, I always joke that WaveTech is like karaoke for the markets, and with auto tune, and it tells you what the next word is and how much to buy and all that. If you just did that, it was a 76% return in a market, in a sector, in an industry group that was supposedly going to collapse. And this goes to my contrary thoughts on how to do the markets. I just look at things a lot differently, and I listen. I don't have it on right now, but I have a TV over here. Usually I have Bloomberg on, and it is absolutely a gold mine for contrary opinions. And especially when they have the Bloomberg analysts on. These people are good, okay? They got it mostly all wrong, and they're giving you all the right things to do, or the absolute places to stay away. Most of these people on all of these networks, they're buffoons to a large degree, and it's unfortunate because the channels like CNBC and Bloomberg, they don't allow these people to trade. And I'm going to go down this trail. I've got somewhere else I'm going to go right after this. But I was asked to be head financial analyst for a firm. We had about 5,000 reps, and I told the COO, who was a good friend of mine. I ran a large division at the time for the firm, and I told him how I wanted to be compensated for giving advice out to the firm. We used to have this little squawk box, have a little microphone, and you would talk into the squawk box. You could talk to everybody that had it on their desk, and I was on every morning. So I said, here's how I want to get paid, and there's a point to this. As I want to be paid, I want you folks to give me a house trading account, that every trade that I tell our people, our brokers to do, that I have to put that trade on in that account, and I get compensated for how well that account does. I get 50% of all the profits from that account, and you guys take the risk, but the risk goes to whatever you would pay me to do that job for a year. So I said, don't pay, and then this way you have no W-2s to put out. You cut me off. I'll still do the analysis if you want me to, but that's how I get paid. And I had a crazy year, and unfortunately the firm blew up, and we won't go through the whole story. I should probably do a video on that. I could bring on some people that were associated with that, good friends that for a long time. That was 1990 actually. And but the point of this is there was skin in the game when I had an idea, and this is why I try to get people to make sure it's easy to talk about things, but these people on Bloomberg, CNBC, all these stations, if they had skin in the game and they had to put skin in the game, they would say a lot different things. That's my point. There's accountability in what you say. And so when you and I, individuals, I know some of you are investment advisors that watch me, we have to make decisions that even affect ourselves or other people. And those are big decisions to make. And unfortunately, a lot of folks don't take very good responsibility, and you get punished for being wrong in the markets. And if you're an individual, you get punished by losing your money. And if you're an advisor, you get punished by losing somebody else's money and then getting fired. And that's how it should be. But they're big decisions, and when you take on the accountability that's necessary is when you do the best for yourself and others. That's just the way it always is, right? So investing is no different. Sorry to get, there's a little rant for you, but my point is I'm an optimist. I want to give back to you guys. This article series of articles I'm writing is actually going to be, I just finished the philosophy, the concepts behind it. There's a couple things the first doc is going to have. The next doc is going to be talking about starting to shred these ETFs, because think about it, these ETFs, even though Kathy Wood hasn't done very well and she had too many meme stocks and she's keep buying more and buying more until you run out of money kind of person. These folks spend a lot of money researching, especially the ones that are doing managed strategies or specific style box strategies. And those are the ones you want to go to. You don't want to, you can ETF hack at SPY, but it's why. What you want to do is you want to end up just like with the XBH that I hacked last January. I think there was 80 some stocks in there. I came up with 21 stocks through the methodology of honing them down, and that made there might have been some that I missed, but the returns on that was very good. So I'm going to pass. That's one of the things I want to pass on, and like I said, that's going to be on the Substack as well. Yeah, you know what, Good Life, I don't know who you are, but send me an email, info@Kendall Report. Maybe we can talk. Interesting. So we said it, right? So I still have the chart up here. So we went down. So it looks like JR42, Fed to focus on balance sheet going forward. Who is SS Warrior?
Watch them, Smurfs. Hey, $100. Abbey Road, man. Nice to see you. I wish you'd spend that money on our products. I would rather have more than just words to give back to you. But thank you so much. I'm just looking at some comments. Yeah, just there's just a lot of things that I think I've had a lot of time to reflect. You know, one of the issues with doing the daily reports that I do is when I was doing daily live, it just took so much time I'm still spending that same time, but the nice thing is I'm doing it later at night. I'm a bit of a night owl, and I like to stay up, and it's a time where there's nothing around bothering me, and I can think clearly, and that's when I always like to write. And but it was very distracting doing the dailies, and it was really affecting a lot of different things here from that standpoint. And yeah, so I'm just looking at some more comments. Yeah, Brad, what cash markets? What I'm trying to do, and questions about the Substack here. This was last night's report. Market turbulence ahead, and we're definitely getting it. Just hit. There was some things that are starting to show up here on some of the indicators. The algos were right at. It was funny because if you go back several weeks ago, nice thing is you can go back to the reports and see some of the different aspects of you know what I was saying and all that. So yeah, I'm just looking here. Yeah, let me do a couple questions here real quick since we're hanging out, and we'll go back to markets here in a little bit. Excuse me. Yeah, so yeah, Brad, as far as the S&P, NASDAQ, cash, I guess I could do that. There are some slightly different contexts there. Because the cash sometimes won't fulfill some of the elements that the futures do, because futures are trading virtually 24 hours, not quite, but for the most part, 22 hours, 21 hours minimum. So you do get some different price movements there. I'll take a look at it, see what it would take. How about this? I'm talking to Brad here. How about if I just added the charts and yeah, let me take a look, and maybe I can put a brief comment to update what to look for in a cash market. I'll take a look at that. Yeah, so let's go back to markets here real quick. Yeah, 4902 is big number. We're printing what, 48.91 last trade. Let me see what the low for the day was. Low for the day, 75. It's interesting because I'm just bringing up. This is something we'll want to watch for here, folks. Right at the close, the PPM1 is going to turn up here on, let me go full screen. Yeah, we're looking at an hourly graph here. Looks like the PPMs are going to try to make somewhat of a turnaround here on the final hour. So as we come in overnight, we'll probably come back into these moving averages.
I may start to include one of the, I think, more powerful things that I used to do on my daily live streams is talking about the hourly movements and forecasting different ranges. So maybe I'll bring that in. Yeah, just going back to Brad real quick. Yeah, so I think this weekend is going to be very helpful to you because I'm going to go through quarterly, monthly charts, and I usually focus in on the S&P. Maybe we'll bring in some focus as well on the longer term aspects. And I see Abbey Road, you're talking about sustainability cause of further selling. Yeah, interesting. Yeah, like I said, the Fed's not going to move off of where they've been. See if everything's, yeah. Looks like things are working again. 1 second. There we go. That's a better view. But like I've been saying, the Fed's not going to move off of this dialogue that we've been hearing for a while. They're just committed. There's things get so out of hand, running, basically zero interest rates for better part of a decade when they shouldn't have been. They should have been 4 or 5. They should be where they are now. I'm arguing that we've normalized yields. I think they're even a bit low in my viewpoint. I still think the 10-year probably belongs 5.5. And I think that's most likely, most likely what they're going to end up at. And that might take another year or two. And like I said, if they don't start to change that QT, if they remain at the pace, so we're back to the Fed here, folks, if they maintain that pace that they've been liquidating securities to get to Bob's number, not their number, my made-up number, which is 6 to 6.5 trillion, to get the balance sheet down to that level is going to take another year plus, just at the pace they're at right now. So I think we have to expect to see these yields staying higher. I think I've got it handled. One of the things I've been pretty good with, you folks should know, is just the level of yields and how they've been migrating around. And I'm as sure as I've been about anything is that range that I put out last night's Substack is important, which is at 4.25 to on the basis of 10-year. 4.25, 390, 395 is probably the bottom end, and we just get locked in there. Still a potential spike up into the 430 level, but I don't see it going much above that's extreme, and 390 is kind of the bottom end from the standpoint there on the 10. And ultimately, the back end of the yield curve just is very flattish. It's going along that sideways flat line. And I still am convinced that those numbers that are in the economy right now, folks are talking about the lag. Well, the lag is no longer a lag. The lag is where we are. You can talk about, well, all this big lag in yields. They're all in the marketplace now. That's why we have seen a bit of issues coming into some of the real estate numbers. But there's so much demand for real estate that's going to be limited from that standpoint. And even I think this last report, if I'm going off memory here, was showing that we did flatten out a little bit as far as prices starting to flatten out. And even if they decline a little bit, they're just not going to be any big disaster. How many of you remember last year the millions, tens of thousands anyway for reality, of videos on the coming real estate crash? There's some guy out of Dallas, man, he just won't give up. He keeps getting on my feed when I go to YouTube, and I just have to, the same guy, and he's
now people are talking about all these houses that are being rented by the builders, and that was part of the strategy, by the way. People act like that's a negative. That's exactly part of the strategy. I've been trying to get my brother to come on with me and do a live stream because he's got a handle on the real estate stuff. He's in commercial real estate lending side, and he's told me that how it's way worse than it was in 08, 9, and 10 as far as deals go. But now some things are starting to break loose, and we're starting to see some activity in certain areas. And that's, from my viewpoint, that's just how the real estate market works. It just goes, there's demand there. People figure out how to do deals in the current structure, and they do what they have to do. But the builders, there's a term for it. It's basically build to rent. That's not the exact term, but that's what's going on. These builders are building these houses. They're putting inventory out there, and they're building them, and they're renting them. And guess what? If prices stay fairly stable, they're going to be able to sell those later. Maybe not all of them to BlackRock, but maybe. They don't actually care, but they're building these houses, the inventory, and they're getting income off of their inventory. I remember way back in the day when the automakers got smart enough to finance their own inventory, GMAC and all those guys. All of a sudden, they thought, well, we're having trouble selling cars. Why don't we finance it? Well, just all right, so bringing up the long-term bond futures for Chris. Happy birthday again. So we're coming right into some numbers, but if we look here, this is a daily chart. We're looking, the algos are suggesting we're going to see more strength, and there's no fib targets on the upside, nothing to really look at there. But we do have a decent pattern, and right now we're trading at 122.02. Looks like a previous high range. We were 123.13. But the algos are suggesting, PPM 1-2 are suggesting we're going to stay above that 21. So you got support levels right now at, let me just find this numbers here. Support at 121.83, and then I said resistance up at 123.15, we'll call it. We'll just round it off up there. But as far as the trend goes, it looks like yields continue to rally, or bonds rally and yields to come back in. This may print us down relative to that 10-year scenario I was putting out. It was probably back at the heading towards that 395 on the 10. That'd be something on a relative. Was I think, yeah, the 10-year note features are ZN. So this is actually probably a better indicator, Chris, for this. There's some Fibonacci targets on the 10-year futures. My primary trading markets from 1981 probably through 90, that was my primary trading market, was the treasury bonds. I did a lot of work with mortgage pipelines, a lot of hedging in this contract. But yeah, so we're looking at on the 10-year, we're almost at fib target 1 here. Let's just put the numbers out there for you.
112.14, 113.02, and 113.14. We'll call that's this higher end up here, which is basically a retest of that same level when we were looking at the 30 for it to come back into that level. Thanks for you folks that are even rejoining. If you first time you join this stream, there's 2 other streams. We're having some internet issues and it keeps kicking us out. So hopefully we won't get done any less. So let's we got about 20 minutes to go in equity. So let's flip back over there. I hope that was helpful, Chris. So we get a billion imbalance on the sell side right now, coming in at 1 billion to sell on MOC, market on close. We'll see if how that plays. A lot of times these numbers are contrary, where they're claiming there's big sells and there's actually more buyers than sellers, or they get offset. It's a pretty ugly day. I guess when I put out, I've told you folks this before. Let me go to the screen, sorry. Yeah, I told you this stuff before. If I mention a number, it happens. So last night, if you look at the analysis here, let's just look at it. Let's bring this up. This is the 4903 number. Next 2 sessions would indicate a decline to 4840. It's on this line right here. So that's where I was talking about that. And I was already acknowledging this was about 2 a.m. East Coast time. It was about midnight local time here when I was writing this, but it seems to coincide with this upcoming Federal Reserve meeting, which will obviously introduce some extra. But here's the other number. There's some other numbers that are possible here, and those numbers are putting us at the 4,800 to 4,790 in 5 to 8 sessions, and that will be only confirmed if we close under 49,003. So let's go back to the chart, and we're here at 48.76 last trade. So I would say it looks like we're probably going to get that close, and we're mostly to that level. I really believe what's going on here. If you look at those of you that have the WaveTech indicators, if you don't, you can get them. Go to kendallreport.com/indicators, and it'll walk you through. There's videos and explanations and all that. There's also a video that goes along with each one on how to use them. But the bottom line is, if you look at those things, let's go over to the daily here and just take a look at it. If we look at this, we're clearly, I'm going to blow these numbers up here. I'm going to attempt to make this a bit bigger. All right. We look at the algos here on the 10. It looks like we're going to start to decline fairly sharply. I was talking that we should be able to hold the 21 period moving average, but now with today's action, it has now gotten down. Right now we're at 0.15, and those of you been around in the old live trading room, you know that 0.15 is the minimum value on a PPM to be able to hold that hold that line, or otherwise the value of that moving average. And those of you that may be new around here, is the theory of a lot of my work is using moving averages, but actually there's probabilities of the moving average holding versus them breaking down, and that's what the PPMs tell you, what the probabilities of those things are that are happening. I'm going to throw up a weekly chart here real quick. I'll go full screen. If we look at the weekly chart, you see weeklies already broke the first derivative. I've been discussing that as well. There's still relative strength staying in the 21. Still 1 billion to the sell side, MOC imbalance. And then we look at the 10-period moving average here on the weekly basis. That's 47.86, and that's at a very robust number at 0.92 plus. So anything over 0.25 is a trend. A value of 0.25 will tell you exactly what is likely to go on. And I'm those of you who've been around for a while, you know this this chart I'm about to show you. 1 second here. So I'll show you this. Let me make it full screen. This is the probability map for the this is the probability map here. And this is what we're talking about. When you get above 0.25, the percent probability of the market declining below that moving average, or if it's inverse, it's declining at a minus 0.25. This TV stands for basically a typical, this is typically what the moving averages will tell you internally. And then there's 3 different things. If they get above 1%, 0.1 or 1.0 plus, then you usually get into an extended peak, so you'll see an extended rally, and then there's a parabolic curve, which is where the markets are going parabolic. So we're probably more in here hitting terminal values on some of these moving averages, and likely to basically start to stall here and at least retest this 10-period moving average, which right now I'm just looking at here. I said, yeah, it's 47.86. So that would be expectation. We'll also look at the market grid weekly. Let's do that real quick. 49.68. We were almost satisfying that today. 49.68 is 64. I'm sorry, is S2. We've had a low of 73, and the S3 level on the weekly is 48.36. So that should put us there. Yeah, let's go to a 1-minute graph. Yeah, it looks like a fair amount of pressure coming into the markets here. We're going to do, let's see if I can get this to work here. Let's watch this together. This is actually a 5-second chart, and right now there's downward targets for 72 down to 71, all the way to 70. And you can see the projections here are basically showing stable going out. These algos that we have coming out here are projecting about 6 minutes in advance right now. I'll pull it over here so you can see it. And so right now PPMs are suggesting we're going to trade back into these averages, but you see the slope that's being projected. So there's two things, the PPMs and then you have the wave tech. They're called the WTR forecast. It takes the percent gains or losses, and it's projecting them into the future using auto regression. So we can kind of see that it's projecting, if we go out here to coming in to about 2 minutes before the close, right now it's projecting prices down to about 73. And we'll watch this. It'll start to flatten out as we get values coming in. And one of the things, this orange line is the 200. If you folks have these indicators, you see that on a 5-second chart, it starts to forecast above that 200. There's usually a reasonable pivot that comes out at that point in time. You can still see the downtrend. We're bouncing off the 10-period moving average here. PPMs are getting a little weaker here. And you see the forecast of the averages. I use these when I'm day trading, folks, to help identify points, turning points here. And typically what I'll do is I won't have PPM 1, 2, and 3. I just have the WaveTech 200 indicator on. That seems to be the best one, but we're still staying negative here. We're down. Here's the 72. It was projecting about 2 or 3 minutes ago, coming down into the 72 range. So we're definitely getting that. Looks like there's a possibility of a move back up here. It's already doing it by the time I can tell you. Back to 74. We got resistance right here. 73.25, then 74. It looks like it's going to try to turn. There's a 74. So this is a great, if you have to have real time, and I don't know if you have to have a pro version to get to this 5-second chart, but I have that on my big, I have 6 screens that I trade off of most of the time, and when I'm on those screens, I've got a 5-second, a 1 minute, a 5 minute, and a 1 hour chart. The 4 sequences that I'm looking at to make decisions, primarily for day trading. You can see we're still got this forecasting lower prices here. We're printing 71 here. Now this would be kind of, yeah. So definitely got some. Last I saw, we still have a projected $1 billion worth of stock for sale MOC. We'll see how that all plays out. That's not really a lot of money. It sounds like a lot of money. So now the algos are suggesting we're going to get a potential turnaround right here. We're still trading 71, 70, 75, printing new lows. Lots of selling coming in here to the close. That's forecasting a little bit of a turnover, probably back to 72.50. Maybe we'll see how. You can see this projection out here. These are, you'll see they're moderating the downside a little bit. So we just got a Fibonacci target on the upside, projecting to the 200, which would be 73.50. So it looks like we're going to get a little bit of a rebound.
I know it seems ridiculous to look at a 5 seconds chart, but there it is. I mean, we're already moving it. So we got, there it is. There's the 200, went right to that number. And that was all being forecast here by the PPMs. Now we've extended this thing. Check it out. Yeah, so that turnaround was being forecasted right there. Probably top out in here. It looks like PPMs are starting to top out. So a little volatility as we come into close. What do we got? 5 minutes to go. So now we're getting an echo. Is that what you're saying? How about now? Is there an echo now? All right, thanks. Yeah, this has been quite the cluster trying to do this live stream today with multiple breaks in the internet. So, so I think it's that one setup. I guess when you don't turn the machine on, I had it fine-tuned pretty good using it every day. But I use OBS Streamlabs, and they've had a fair amount of issues. And I put a new video card in this computer about a month ago, and nothing's been right since. I put an NVIDIA pretty powerful card in here, thinking I was gaining a lot of power, and it's caused more issues than nothing else. So we got a little stability here. Looks like everything's starting to come back into play. What do we got here? 3 minutes to go. All right, folks, I'm going to come back up and just finish off this way. If anything drastic happens, we'll talk about it. But just thank you so much. Very frustrating. You know, we had quite a few people listening and an internet break, 3 of them in this one live stream today. So that's kind of unfortunate. But anyway, folks, the plan is, just kind of summarizing things, is, like I said, the Substack is going to be my daily analysis. You can see some of the numbers I put out there. They're trying to overcome the LNG freeze on exports. I just saw a little flash come through. I really appreciate everybody coming. I had a couple good rants. One of them you didn't get to hear because the internet collapsed and I didn't know it. That's unfortunate. I'll have to go back and see how much of that actually got done. And I guess if it were possible, I could go in and download all these, put them together, and replace it on the internet as one video. And we'll take a look at it. It takes forever for these live streams to convert and then to download them and then to do all that. It's like a multi-hour task. So anyway, we'll close out here. Thanks for everything, and make sure you get the Substack subscription. It's $8 a month, not a lot of money. We were joking this morning. Mason and I were talking, and
we were joking that it's only a half a cup of coffee now at Starbucks, $8. So it's really not a lot of money. It was interesting, the old newsletters that I showed you folks on Twitter, there was like there's a close. That old newsletter was, we used to charge, I think it was originally like $240 per year, and there were only 24 instances. Now we converted that to $23, and it was almost $1,000 for 24 issues, and now I'm giving you 22 every month for $8, so, and $80 a year, and so it's a good deal, and it's interesting because a lot of what we're planning on doing is going to come around Substack, giving the ability to write. Maybe there'll be some podcasts. I'm looking at that platform as a really good platform to work on. I've been very, very frustrated with YouTube for a very long time, and we got to 32,000 subscribers, and we just can't seem to grow. But we're going to try. I did a live stream today because I was hoping to hang out with everybody. Unfortunately, we had the internet breaks. But we'll try this again, and I'm not sure what was going on with the internet around here. It's usually incredibly stable, as I have a lot of trading activity that happens here, and I'd be going crazy if that was happening in the middle of a trade. So typically we don't get that. Somebody wants me to look at Bitcoin. Yeah, it'd be interesting to see what Bitcoin did here. So I'll do that. I'll bring it up. Let me just take a quick look here. Yeah, thanks, Dave. AIM Dave, thank you. I'm enjoying the Substack. Like I said, it's taken me about the same effort, but it's only taking about 10 minutes. If you have the Substack app, it will read it to you, so you could actually play it in your car or in your earbuds. The charts are there. You can click on any of the charts. And in fact, let's go over there. I think it's pretty good. So here's the Substack. If I come over here to this chart, I can click on it. It brings it up full screen. And so that's handy. Over here on the right-hand side are all the market grid numbers for each market. And I kind of change during the week. If there's nothing going on in some of these indices, I may not cover them. I try to cover Bitcoin every night. I'm going to go through a Bitcoin analysis here. But last night, Bitcoin pretty much summarized it, I think, pretty good, where the expectations are. And I'm trying to lay this out as well as possible, so you have some trading points off of. And like I said, you can bring up the graph here, and these upward projections are still valid there. So there's a lot higher prices potentially for maybe 60,000 on Bitcoin. So let's go over here. Take a look. Here's a daily. I was talking about last night's video that was a pretty good chance for a ramp up on the daily. So today should be the bottom. We should see a bit of a rally, and there's very short-term Fibonacci targets of 46,100. So I would look for that number and look for probably the 21 period moving average, simple average 42.17. Looks like the number that we're probably going to stay over that. So look, call it 42,000. We should stay up there, and I think there's a better than even chance that we're going to get into a new high, a little bit of a rally for a couple of days, and then we'll set back into the pattern. So I will tease you folks with one thing as on closing. One of the rants, I'm really disappointed that the internet broke when it did, because I was about to go into basically, I'm going to make a comment, and I will tell you, I did a special report on Tesla last week, and I was talking about it going to $1.80. Of course, it went right to $1.80, and people were going, oh, that was a great call. Listen, all it was the WaveTech Fibonacci target 1. I didn't call anything. The indicators picked up this pattern. It was like 180 was the minimum. There were some other numbers. I always look for cluster numbers to kind of validate those potential ranges and look at the PPMs and how they're running. But I will tell you this, if we had lots of people on here, this would probably really get them going. But I think there is, and I'll tell you what, I will do a video on this, okay? I think it's worthy of a video. There was what I call the death pattern chart formation. And I've seen this over the years. I could tell you Lehman had it, Bank of America going back 2008. There were a bunch of banks had this death pattern. And it basically were projecting prices to zero, and most of those banks got bailed out. And during the meme stocks, and let's go to probably 2021, when those stocks are getting hammered, and there was some kind of best way to put this. There's a mentality out there, and I'll just say, and I don't want to target any group, but it appears to be like millennial traders, that they think revenues is all that matters. And they were talking about all these companies, they got great revenues, and their stocks are going to go up forever. But it comes down to bottom line. And so there was a big dialogue on Tesla about doing $100 billion in revenues, but when you start looking at margins, they lowered prices, they did a bunch of other things. All of a sudden, it ended up to be a really big negative. And I would tell you that the Tesla stock, I would do a video on this, is in a death pattern, and it's probably going to $20 a share. I've said it out loud. It's going to somewhere between 40 and 20 bucks. And we'll retest that. I think it was a 23 low. We'll retest that, and it's in big trouble. It'd be interesting to see the richest guy on the planet become bankrupt, because at some stage, if prices drop to a certain level, I'll save this for the video, that Elon's going to have to sell. And once he starts to sell, everybody's going to want to get out, and it's going to crush his stock. So it's never been, it's always been an overpriced stock, and now there's something else. These are teasers. The other thing is that the EV market's dying very quickly. And as far as the potential of EVs being everything being EVs, electric vehicles, I've said this before, that's not going to happen. Fossil fuels, they're not even fossil fuels. Hydrocarbon fuels will be around for a very long time.
Everybody talks about fossil fuels. Well, they on Titan, on one of the moons and Saturn, they found a whole lot of this stuff. So there must have been a whole bunch of dead animals up there to rot. They also find oil under 30,000 feet in the crust of the earth, which is unlikely that that's rotted animals. Anyway, I will do the video on this thing because I think it's worthy of it. I may do a write-up on Substack and then follow that up with a video. But there are big problems ahead for Tesla and this pattern. And this isn't going to happen overnight, so it's not going to happen in 3 weeks. But it's in what I call the death pattern. And you start to look at the financials, it's just going to get worse and worse. And you have to realize that Tesla would have never sold any cars without subsidies and all that. And then anyway, I'm going to save it because there's a lot to say there. And I always tell you folks, doing reverse fundamentals. Like if there's a death pattern on Tesla, what would make that happen? So then you have to go and dig up, okay, this, and this would have to happen. Then you have to go and look, is that probable? Are there things that are saying that this is becoming to be a reality? All those kind of things. This is how I do what I call reverse fundamentals, which is technicals are driving me. Then I go out and see if there's anything happening in that market, in the economy, or whatever it is I'm doing analysis of, to come up with that scenario and see how realistic these concepts and ideas and probabilities are. And I've been right a lot more than I've been wrong on these kind of scenarios. And, going back to the meme stocks, I remember there was some guy I was following on Twitter, seemed like a nice kid, young guy, young investor. He had all the meme stocks and just touting this stuff. And when they started to roll over, I tried to tell him, this is the reality, and you have to realize that once these stocks get into this pattern, they don't come out. And I've seen this pattern in OTC, pump and dump stocks. They're all look the same in the end. They all act the same. There's way more stock for sale than there is people that want to buy it. And that's always a problem. I don't believe that that long-term investors really exist. After 44 years, I'm convinced of it. But anyway, thanks folks for hanging out. Sorry for all the internet breaks and all that. Yeah, absolutely. Somebody's going, hydrocarbons from dinosaurs is a complete myth. It's a mineral, okay? And there's more of it than you can imagine. And it's going to be around forever. They're actually pumping more today. I think Kalashi is what, I'm not sure I pronounced your name right, but if I remember right, you and I are similar age group, and we've been told that we were going to run out. And the whole idea, by the way, David Rockefeller was a really smart guy, and he figured out how he was the one that coined him doing fossil fuels because he wanted it to sound like, something that was going to run out. There was only going to be so much of this stuff. So he built in scarcity from the very, very beginning, and it's never been scarce. And there's more of it now than there ever was. And if it wasn't for governments and other people trying to shut this stuff down because they have an agenda, because now they want everything to be electric, even though they haven't figured out how to make that much electric. That's another problem. That's what we're seeing, with the EVs. What you're seeing is governments trying to force a technology onto the people, and people don't want it. Call a Ford dealer and ask them how many F-150 Lightnings they have hanging around in their lot, and probably most of them that were ever shipped. I don't think I've seen one of those on road. I've seen 2 Rivians, and those things are supposed to be
some of the worst vehicles to own, period, from a maintenance standpoint. But anyway, I digress. Let's end the day. Thank you so much. Sorry again for all the internet breaks and all the stuff. I wanted today to go much different, but we have to deal with what we get dealt. So thanks again. See you on Substack. Make sure you subscribe. Remember, you might see a post, but you're going to have to read it all. You're going to have to ante up the $8. And it supports everything we're doing. I'm telling you, we got some cool stuff going on, and we've had a lot of subscribers already. But I'm just telling you, subscribe, because this is going to be the backbone of a lot of things we do. And I just got a banner flashing up, Fed rate cuts hammered. So yeah, nobody's thinking about rate cuts right now. All right, folks, have a wonderful rest of your day. Don't forget to read the newsletter tonight, and I will talk to you all next time we get together. Probably a video coming in early next week. Thanks again, folks. See you later.